The purists must have frowned at Friday's sharp reversal of over 100 points in Nifty. Here is why. It was last April that S&P had downgraded outlook on India's sovereign rating from stable to negative. In June, Fitch follows suit. Predictably, the warning wasn't taken seriously. If it was only in private. Since then, exports have fallen, oil prices have increased, rupee has depreciated, both GDP and IIP numbers have nosedived, inflation has stayed significantly above comfort zone, RBI remains unconvinced about the wisdom of rate cuts, banks' asset quality has turned alarming, fiscal deficit has ballooned, all political parties continue to play Santa Claus, and Prime Minister's office protests unprecedented adverse international media coverage of Dr. Manmohan Singh's second innings. The follow-on visit from Moody's is almost due. Being rated at the very last rung of investment grade with a negative outlook, Mr. Chidambaram, a veteran in finance ministry, understands the odds of India getting relegated to junk status. Were it to happen, the $13 billion inflow from FIIs in calendar 2012 could reverse very quickly. That in turn will worsen our balance of payment, putting further pressure on rupee, make imports dearer, push inflation up further, cause fiscal deficits to mount, harden monetary stance of RBI and choke investments further. In short, that one outcome can cause the economy to spin out of control. Mr. Chidambaram has taken the threat seriously. Early signs are constructive. GAR deferment is virtually confirmed. Vodafone case is being looked afresh. He has acknowledged publicly that revival of investment climate, containment of inflation, and fiscal consolidation are his top priorities. With monsoon session of the Parliament having come to a close, market expects to see executive action. With their back to the wall on every front, most believe more inaction is no longer an option. It is this resilience of the market in the face of worse news flow that must be watched carefully. Barring an actual downgrade, which indeed is a possibility and can prove catastrophic, the market is pinning its faith on a situation that can scarcely get worse. Now it is up to the duo of Prime Minister and Finance Minister to show some mettle. Mario Draghi came to the rescue of equities on Friday. His promise of bond buying without limit was cheered by exchanges around the world. Coming after Ben Bernanke's remarks in Jackson Hole, this was enough to reassure the markets that central banks stand committed to further stimulus, which is only going to help the cause of the risk assets. Bond yields of troubled countries showed remarkable improvement and equities stabilized. Last week saw both the Republican and Democratic candidates being formally nominated in their respective party conventions. While Republicans unabashedly champions the cause of unfettered capitalism and relentlessly criticizes the state of economy under President Obama, it is indeed a sobering reminder that Dow appreciated 67% during his first 1325 days in office. Remarkably, in the 112 years of Dow from 1900 to 2012, that ranks him fifth most successful of presidents in that scorecard. Even more creditable if one takes into account the near-disaster scenario post-Lehman moment that Obama had to face within 20 days of assuming presidency. As someone tweeted last week, only Clinton could have summarized Obama's record better than Obama himself. Nifty found support close to 200-day exponential moving average at 5,215 and gained over 100 points on Friday to close the week at 5,342. There were lots of technical reversals that suggest the beginning of a short-term up move which should test the previous peak of 5,448, a mere 2% away from Friday's close. Surpassing 5,448 will be significant since the new intermediate high will reconfirm a higher top, higher bottom formation that started back in June. Next week, hope of stimulus money finding its way to Indian equities and hope of seeing action triggered by the finance ministry should keep equities strong. Percentage play will be there to spot new opportunity. QuantPair Fund booked profit in all 11 trades entered last week. Even at the lowest exposure level, the profit amounted to over 2% of the portfolio. The rapidly changing perception of banks based on adverse news flow and market gyrations helped us spot excellent opportunities in the market through our algorithm. This season, which began after Q1 results were announced, QPF has completed 14 trades, of which 12 resulted in profit. Consequently, we ended last week up 25% since we began, against a Nifty languishing a minus 9% during the same period. And we insist that there never was an occasion we lost sleep due to misbehavior of the markets. Comparative Value Fund widened its performance over Nifty to 10%. Friday's sharp reversal notwithstanding, we remain alert to the pervading negativity in the economy. But we are hopeful that, sponsored by the Finance Ministry, we could see positive initiatives next week that could sustain Friday's move up. While our swing trade in NMDC has so far not worked out to our satisfaction, we expect to see the stock moving in our favor next week. On the watch list are Reliance and HDFC for swing trades. Thanks for watching.